Okay, let's just dive right into this explainer, because we're looking at a truly fascinating mathematical concept today. We're talking about building wealth that doesn't just, merely survive extreme market chaos, but actually thrives on it. Welcome to the idea of the anti-fragile portfolio and mastering convexity. We're going to uncover how certain assets and strategies can literally insulate you from the absolute worst market crashes, all while setting you up for exponential outsized gains.
But to start, we really have to ask ourselves a pretty uncomfortable question. Think about how incredibly stressful it is when a sudden, unpredictable black swan event strikes the economy. Most of us go through life building these traditional, moderate-risk portfolios, basically just assuming the market is going to behave reasonably and predictably. But, well, history tells us a completely different story, doesn't it? We have to understand how these standard, everyday investments actually hold up when a massive systemic shock strikes completely out of nowhere.
The core threat we're really facing here is what Nassim Taleb calls fat-tailed risk. These are those terrifying unknown unknowns that completely destroy the illusion of safety we think we have in a moderate risk portfolio. Simply put, fat-tailed risks are those extreme financial outcomes that are just impossible to statistically model or predict. Standard statistical models fail over and over again because they severely underestimate how frequently massive market shocks actually happen in the real world, and that leaves the average investor entirely exposed to absolute ruin.
So, how do we beat this? To conquer this kind of ruinous threat, we use a profound mathematical concept called convexity. Think of convexity like a giant snowball rolling down a hill. It's effortlessly picking up mass and accelerating the further it goes. Concavity, on the other hand, is basically like blowing air into a balloon. You have to work harder and harder for diminishing returns, the pressure keeps building, and eventually, it just pops. Convexity means your growth builds upon growth. Your gains rapidly accelerate. Concavity means you carry all the built-up tension and risk until it bursts. Ultimately, we want our wealth behaving exactly like that convex snowball, not a concave balloon.
When we contrast a fragile strategy with an anti-fragile one, a highly distinct pattern emerges. In a fragile scenario, you are taking on asymmetric or even dangerously asymmetric downside risk, where extreme volatility can easily lead to a total wipeout. But in an anti-fragile scenario, a completely different dynamic takes over. This is convexity in action. You establish a hard, unbreakable mathematical floor on exactly how much you can lose. However, the ceiling for your gains, that's left completely infinite when volatility strikes.
Let's look at standard stocks for a second. Buying shares initially looks like a perfectly symmetrical bet, but if you hold them long enough, the sheer force of compounding kicks in and completely breaks that symmetry. Think about it. If you buy a quality stock, your absolute maximum loss is strictly 100% of your investment. It can only go to zero. But your upside, it could be 500, 1,000, or even more. The longer you hold quality assets, the more the underlying math of compounding bends the entire curve in your favor. It becomes powerfully convex to the upside, while naturally capping your downside.
Now, this mathematically rigged advantage, and it is rigged in your favor, becomes even more explosive in the options market, because options are nonlinear instruments. They move very differently than standard stocks. When an options delta, which is just its sensitivity to the underlying stock price, moves rapidly, it triggers something called gamma. Gamma is basically the rate of acceleration, and it gives buyers a highly convex, explosive payoff profile. Active traders literally use these long gamma positions to rapidly multiply their gains during wild market swings. When we break down how different assets handle this volatility, we see some really stark differences. Buying options or holding U.S. Treasuries gives you positive convexity that inherently protects you. For instance, U.S. Treasuries actually gain value at an accelerating rate when interest rates drop. Conversely, selling options gives you a strictly limited upside, just the small premium you collect, but entirely exposes you to theoretically unlimited losses if the market suddenly turns against you. That right there, that is the dangerous balloon. That is pure negative convexity.
So, it's pretty easy to see how paper derivatives and complex financial instruments benefit from this math. But what about physical, long-term holdings? Can a brick-and-mortar building truly act like an options contract? Let's pivot for a moment and explore how this exact same crucial concept of convexity applies to tangible assets, the kind of stuff you can actually see and touch.
What's truly fascinating about private equity real estate is how the physical, intrinsic value of the dirt and bricks acts as a hard anchor against massive losses. People are always going to need a physical place to live and work, right? And that creates a very solid floor on the downside of the curve. At the exact same time, over the long term, rising demand and the fundamental ability to steadily increase rents provide that long, trailing tail of theoretically unlimited upside.
And the empirical data totally backs this up. Following a massive systemic shock, real estate recovery is actually highly convex or superlinear. Why? Well, because when a massive crisis hits the economy, builders stop building. They freeze new construction entirely, which abruptly chokes off supply. But population growth and fundamental human needs, those don't stop. So when the dust finally settles, you have a massive shortage of supply meeting rising demand, causing property values to compound rapidly and explosively upward.
But here's the best part. Convexity isn't just some concept reserved for Wall Street traders. You can find these asymmetric payoffs in everyday life. Whether you're investing a small amount in a friend's startup, flipping a distressed house, or even just spending your weekends learning a high-demand tech skill, in all of these scenarios, your downside is strictly capped. The absolute most you can lose is the initial money or time you put in. But if that startup succeeds, or if your new skill lands you a huge executive role, the payoff is exponentially larger than your initial risk.
So how do we actually put all this into practice to survive and thrive? Enter the barbell strategy. Formulated by Nassim Taleb, this master plan is designed to avoid the extremely dangerous middle of moderate risk entirely. The barbell strategy argues that medium risk is a complete trap, basically because you're constantly exposed to total ruin from estimation errors. Instead, the strategy dictates that you should combine extreme paranoia with extreme aggressiveness.
This is the real aha moment for structuring your wealth. By keeping the vast majority of your money in something exceptionally safe, like a high-interest savings account or short-term treasuries, and putting a tiny fraction into highly volatile, convex assets, you completely eliminate the risk of total ruin. Imagine a 90-10 split. 90% is totally safe from any market crash. The remaining 10% is placed in highly speculative assets, like long options or Bitcoin, that have a convex payoff. If that 10% goes to zero, you are perfectly fine. But if it goes up 100x, it completely transforms your entire portfolio's return.
It's a complete mindset shift. By shifting away from trying to predict the unpredictable and simply structuring your portfolio this way, you position yourself to actually gain from chaos and disorder. You stop trying to guess when the next market crash is going to happen. Instead, you accept that shocks are absolutely inevitable, and you build a financial fortress that is mathematically designed to catch the massive upside waves that follow extreme volatility.
So I'll leave you with this. Take a hard look at your own asset allocation today. Are you sitting in that dangerous middle, holding a fragile balloon just waiting to pop under pressure? Or are you building a convex barbell, ready to let the next inevitable market shock snowball into generational wealth? It's a fundamental shift in how we view risk. The choice between fragile and anti-fragile is entirely yours.